Li Auto stock is skyrocketing, even though the company is losing money. Let's look at them a little closer to figure out whether they're a buy or a sell. Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day at 8 a.m. In this video, I am going to walk you through the process of valuing Li Auto stock by analyzing their financial ratios and dissecting their financial statements, so we can determine if the stock is a buy or a sell. Li Auto is a Chinese electric vehicle manufacturer headquartered in Beijing. Its specialty is extended range electric vehicles, which can be powered by electricity or gasoline. The hybrid engine serves as a gateway for weaning consumers off of gasoline powered cars. Li has sold 10,000 cars. It was founded in 2015. It is financially backed by the company that owns TikTok. Let's get started with the model. This is a large cap company, $26.6 billion market cap. They're trading at $31.78 a share, and they have 846 million shares outstanding. The way you value a company is you estimate the future free cash flows, and then you discount that number back to today's value. That's what we're doing in this video. And this company has negative free cash flow every year. Net income is the profit and loss for the business. It's revenue minus expenses. They also have negative net income every year. Their revenue is growing as expected. It's $43 million in 2019, then it quadruples to $170 million in 2020. These numbers are converted into US dollars. This is the income statement, which is in yuan. If you want to convert these numbers to US dollars, just divide by 7. So in the trailing 12 months, they had 1.1 billion of sales. The cost of sales was almost as much as their total revenue. So their gross profit was 68 million. They had a lot of operating expenses, 1.8 billion. So they had negative operating income. They also have to pay interest on their debt, and they have some other expenses. So they have negative net income as expected with a new company. And this is the statement of cash flows. And to calculate free cash flow, it's operating cash flow minus capital expenditures. So they have negative operating cash flow each year. And of course, they're investing a lot into their business to grow it. So they have a good amount of CapEx each year, almost $1 billion. Let's look at a capital structure. $257 million of debt, $934 million of equity, and these two numbers are converted to US dollars. Their weighted average cost of capital, which is a blend of the cost of debt and cost of equity, is 14.25%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's 28 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $16 billion. We divide that by 846 million shares. We get a calculated stock price of 1904. They're trading at 31.78, so they're trading at a 67% premium. It's a sell according to the model. Simply Wall Street is a little lower than me. They're at 1645, so they're also saying the stock is overvalued. The way a discounted cash flow model works is you look at the prior free cash flows and then estimate those out into the future. This company has negative free cash flow, so I can't estimate that out into the future because it would be negative, and you can't have a negative stock price. The way I valued this company is I looked at the average analyst estimate for the future free cash flows, and I used that as my base case. Then I looked at the company's financials and also looked at their competitors' financials and adjusted those free cash flows as I saw fit. So the company IPO'd a few months ago, and it's been driven up the price the past few weeks, and I think it's going to go way higher and higher because a lot of investors are really interested in these EV companies. If you invested $10,000 when this company IPO'd, you would almost have doubled your money. That's a pretty good return on investment. This company focuses on the sale of SUVs, sport utility vehicles, and the price of their cars range from $21,000 to $70,000. It's good to understand that a company's financial performance is not always linked to the stock price. A company's stock price can go up higher and higher if there are more buyers than sellers. The company's stock price can go down if a company is reporting great earnings, if more people are selling the stock than buying the stock. So obviously a lot of people are buying the stock, driving the price higher and higher, even though they're not reporting any profit. Let's look at the financial ratios. So the average PE for the market is 15.5, the median is 14.8. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have negative net income, so they have a negative PE. The average price to sales in the market is 5.1, the median is 2.1. Price to sales is stock price over sales per share. To calculate sales per share, that's revenue over shares outstanding. They're at 157, so they're doing much worse than the median and average. The average price to book is 4.6, the median is 2.3. Price to book is stock price over book value per share. To calculate book value per share, that's equity over shares outstanding. They're at 28.8, so they're doing much worse than the median and average. Equity is assets minus liabilities on the balance sheet. The average interest coverage ratio is 12.3, the median is 3.8. Interest coverage ratio is EBIT over interest expense. They're negative since they have negative EBIT. EBIT is earnings before interest and taxes. The average ROE is 11%, the median is 12%. ROE is net income over equity. They have a negative ROE because they have negative net income. The average current ratio is 1.8, the median is 1.3. Current ratio is current assets over current liabilities. They're at 1.7, so they can easily cover their current liabilities. So their current assets consist of cash of 3.5 billion yuan, $500 million of receivables, $500 million of inventory, and some other items. They lost 2.3 billion of cash flow in the past 12 months, so they do have enough cash to cover that. But this company may continue to lose cash for many years until it becomes profitable. It's going to need a lot of cash to run its business in the near future. And current liabilities are debts and payables due within 12 months. Examples are current debt and accounts payable. The best way to look at ratios to compare them to similar companies, I've done videos on Ford, NIO, Tesla, and XPeng, all in the same industry as Lee. And if Lee has a number in red, they're worse than the average. If they have a number in green, they're better than the average. So they're worse in price to earnings or price to sales. They do have a better price to book because the average is negative. They have the highest current ratio of all the companies, so that's good to see. They're doing bad in ROE. They have the lowest amount of debt of all the companies at 22%, so they still have a lot of room to borrow. Their market cap is lower than average, and nobody pays a dividend in this industry. So to summarize, I do have them trading at a 67% premium. Their ratios and financials look pretty weak. Let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.